So you've heard people mention real estate syndications and you're just wondering, what the heck is that? You'd like somebody to explain it in a very simple way. Well, you found your video. Here, I will explain the basics of a real estate syndication using the purchase of an apartment complex as an example. And if you watch until the end, I'll share with you what I believe is the most important factor when investing in syndications. I'm Dan, an active real estate investor with hundreds of apartments, and I'm on a mission to help immigrant professionals grow their wealth passively through real estate. If you'd like a copy of my passive real estate investing guide, click down below in the description. Now, the syndication approach can be used with a wide variety of commercial real estate. And the syndication approach is also very popular with the acquisition of apartment complexes. So that's what I'm going to use as an example today. All right, so what is a real estate syndication at its highest level? Well, it's really just a group of investors that pool their money together to purchase a large real estate property. Why would one want to do that? So the first reason is that you don't have enough money individually to purchase a certain type of property. The apartment complexes that I look at are many millions of dollars, and very few of us have that kind of money laying around. The second reason is that maybe you have the money, but not necessarily the operational experience to manage it. So going into a syndication is a great way to partner with an experienced real estate investor who can help you do that. And then finally, this also allows you to purchase a portion of a whole bunch of different types of real estate investments. So if you've got an investment in this syndication and that syndication and that syndication, it really allows you to really diversify your real estate holdings, which is another great factor. So before defining more about the syndications, I want to talk about the two primary roles because this is really important to understand. Sometimes it's a little bit confusing. So the first role I want to highlight is the general partner, or sometimes called the sponsor or the sponsors. The general partners or the sponsors are experienced active real estate investors who have the knowledge, have the experience to acquire an apartment complex, let's say, and manage it well, increase the value of the property, and then sell it at the end. The size of this team is typically one or two people to several to more. It really depends on that lead sponsor and what they need as far as assistance with other experienced individuals. The second group is called the limited partners. Now, these are the individuals that put in, say, $100,000 or $200,000 into a syndication. They're the ones that put the majority of the money into the deal, and there's a lot more of those because you need to raise many millions of dollars. So usually it takes a large number of investors to take part in it. Now let's talk about the anatomy of a syndication. So let's say we're going to purchase an apartment complex. We'll call it Maplewood Apartments for short. The first thing that's done is an LLC is created, a limited liability company. And this is the company that's basically going to own this apartment complex. And there are two types of investors that I'm going to talk about here in that LLC. One is the limited partners, which I just mentioned a second ago. In most of the syndications I deal with, there are 70% equity goes to those limited partners. They also have preferred returns, which I'll talk about in a second. They're shielded from liability, which is the big reason why they're called limited partners, is because their liability is limited, which is actually a really good thing if you're a high net worth individual. It's a passive role, so there's no control over the property, which is actually fine because you want the experts to really be the ones that are controlling it. And investments can be made, by individual bank account or through self-directed IRAs, etc. The other group is the general partners or the sponsors. And they typically, again, in the syndications I'm a part of, take 30% of the equity. They take second position on all the returns. They absorb full liability and risk of that investment. And they have operational control because they know how to manage that property. So all that money that's pooled, how is that money used? So that money is used in a number of ways. It's used for a down payment, it's used for closing costs, it's used for asset improvements, and there's also working capital and reserves in case there's something unexpected goes on. There's money there in the bank to be able to address it. So what do investors get in return for putting their money in? There's really two things. There's cash flow and I'll talk about that, plus what preferred return means. And there's equity. Let me talk about both of these real quick. Are you liking this video? Click like and subscribe so you can get more videos on real estate investing. Now back to the video. So cash flow is really the money that comes off every month or every quarter from that property. That's the profit made after the rents come in and the expenses are paid out. And the syndications that I'm a part of, and this is a very common thing, is we offer something called a preferred return, which means the limited partners get first priority on all payouts from the operational profits. Now, a range that I've seen is anywhere from 5 to 10% annual preferred return. That's the most common, but it really depends on a lot of different factors. But I just throw that out there just so you have a sense of what to look for. And then after the investors are paid their preferred return, then any remaining profit is split with the investors and the sponsors. So that's in essence what a preferred return really means. The second big piece is equity. So as the property improves its cash flow, its profitability, and the value increases of that property, there's equity that is built up. And so the ownership split between the limited partners and the sponsors is, in, like I mentioned before, in the syndications I've been a part of, they're 70-30 split. Now you'll see 50-50, you'll see 80-20, you'll see a whole bunch of different approaches, but this is the approach that I typically use. And when the property is sold, investors then get a piece of that equity. 70% of it goes to those investors or limited partners, and 30% goes to the sponsors. So this is a big piece because at the end of the day, if we've done a great job with the syndication and really increased the value of it, when you go to sell it, there's a big chunk of equity that can be split amongst the investors and sponsors. So who can take part in a syndication? This is a really important topic. So some syndications only allow accredited investors. So what's an accredited investor? There's somebody that earns $200,000 individually over the prior 2 years, or $300,000 together with their spouse, and reasonably expects that to happen in the current year, or they have a $1 million net worth that does not include their primary residence. So that's the accredited investor definition. Some syndications also allow what's called a sophisticated investor. This is somebody that has knowledge of how to invest. Their acumen could be pretty high in terms of investing in real estate. Perhaps their income or their net worth is not the same as what's required to be an accredited investor, so a sophisticated investor category fits as well. Some syndications allow both types of investors. Some only allow accredited investors. So you'll need to ask when you're looking into this which type of syndication it is. If you want to know more about the roles here, accredited investor and sophisticated investor, I created a video which you can check out right here. Now, what are some target returns and minimum investments? Now, I'm just going to throw this out there. These are just some general numbers that I typically see with syndications. You may see higher, you may see lower. It could really depend on a lot of things. So for internal rate of return, I typically see 14 to 18% over a 5 to 6 year investment hold period. For preferred return, I typically see 5 to 10%. For cash on cash return, a target goal is often 10%, but that can vary too. And the return during the hold period also varies, but 2x is something that is a great goal to have. But again, these numbers I'm sharing with you, I'm just trying to give you a little bit of a sense of what some of the ballparks are. The specific deal you're looking at may be higher or may be lower, and don't discredit it. If it's lower, for example, don't think, oh, this is not a good one. There may be a reason why, and there may be a strong business case as to why a different approach is used that could actually be beneficial by lowering your risk. So it's good to just dig into these and to understand them a little bit better. In terms of minimums, I've seen typical minimums of $50,000 for smaller properties. That's under 30 million, let's say, and $75,000 or even $100,000 minimums for larger properties like over 30 million. And self-directed IRA, solo 401k funds are typically accepted in these kinds of investments as well. Now let's look at a sample investment. Now, we're just making this up. I just want to throw some numbers out there just to give you a sense of kind of what this thing would look like. So let's say Maplewood Apartments is here. There's a deal out there that a general partner is pitching and requires, say, $100,000 investment as a minimum. So that's what you as a limited partner would put in. And let's say they say there's a 7% preferred return. There's a 70-30 equity split, which, as a reminder, means 70% goes to the limited partners and 30% goes to the sponsors. And let's say there's a 5-year hold. So this is the deal and what it looks like. You'll see a pro forma of what the cash flow and the equity might look like. So in this case, there is the $100,000 investment yields $5,000 in returns in year 1, $6,000 in year 2, $8,000 in year 3, $9,000 in year 4, and $11,000 in year 5. Now, it's not that uncommon to see the first couple years be lower because oftentimes there's a lot of money put into the renovations and increasing the value of the property. So the cash flows might be a little bit lower the first year or two. But after that, hopefully they go up to a higher level. And in this case, the property sold after year 5, and the sale proceeds are $162,000, which is really that equity piece. So if you add the $38,000 plus $162,000, you get to $200,000 returned after 5 years. So you start with a $100,000 investment, and it takes you to a $200,000 return, which is 2x your money, which is pretty cool, right? Now, again, this is just an example. There's a lot of factors and variations that can be played with this, but I wanted to make this really simple so that hopefully you could understand at a high level how this works. And one thing that sets real estate investing apart from most other asset classes is the tax benefits you can get. Depreciation is one of the biggest. It's really a way to help sort of expense or have like a paper loss on a property to account for its deterioration over the years, which is a great thing for an investor. That expense reduces the profitability on paper of that investment, which really basically defers your tax liability from the income you make. So in other words, it makes it look like you're a lot less profitable than you really are. So you pay less taxes. And this is one of the great things about real estate that really sets it apart. Many syndications do something called a cost segregation study, where they help to accelerate that depreciation and bring it up to earlier years so you can take more of it, which is a whole separate topic which I can cover in a different video, but I wanted to just mention it. So these tax benefits greatly increase your income, which is great. And you don't get these benefits from investing in cryptocurrency or stocks or bonds. This is really something that real estate is very well known for. Let's talk about the benefits of syndications here. You get to pool your money with other investors, which is great. You get to participate in real estate in a passive way, which is huge if you're a busy professional. You can achieve strong returns. To double your money over 5-6 years is a pretty good return and a lot better than what you can do just by putting it in the S&P 500. Apartments, for example, are a very solid asset class with huge demand, but also, self-storage, and there's other types of commercial properties that also have a really strong story behind them. There's tax benefits, which is awesome, and it's a great inflation hedge because as inflation goes up, typically rents tend to go up too, so your investments return more money. You get to improve the local community because these real estate properties are syndicated, are typically improved somehow. They're made to look nicer, to be more livable, which improves the overall community in general. It diversifies your portfolio if you have investments in a number of different syndications, let's say. And then finally, and one of the biggest things is it grows your wealth over time as a working professional without having to be involved in the real estate yourself, which is the biggest benefit of all. Okay, so I promised to tell you what I thought was the most important factor in a successful real estate syndication. For me, that's picking a good sponsor or general partner. There are a lot of factors that can make a successful syndication, but I think this is probably one of the biggest. Their experience plays a huge role in how well the syndication will do at the end of the day. If you want me to make a video about how to pick a great general partner or a great sponsor, just let me know in the comments and I'll go ahead and make it. Thanks for your time, and if you like this video, check out my other real estate investing videos in this channel.